Our next guest isn't worried about a collapse in the regional banks in the wake of the New York Community Bank big hit, saying that there's viable weakness right now in the sector. Joining us now is Renaissance Macro Research Chairman Jeff DeGraaf. And I have to give you some credit here, Jeff. I've always paid attention to you because Mike Santoli always tells me to pay attention to you. But you've made some really good tactical calls lately, including, I remember when you were on with us in December 18th and said, buy this market. It looks very strong. I mean, it's up 7% since then. So kudos to you. Before we get into banks, do you still think that the rally has legs?
Yeah, well, thank you first and foremost, Sarah, for having me. Yeah, we do. I think we're good. We had escape velocity. That was really the genesis of that call, which we made in November, but it was still in play in December. It should, for all intents and purposes, last at least through the end of the quarter, and that's a minimum. And if we have the continuation of the 20-day highs and some of the internals that we look at, then I think you extend on beyond that. But we should be money good between now and the end of the first quarter.
And you like some of the opportunities here in regional banks? Some are still a little skittish around this sector.
Yeah, there obviously is some concern, which I think is episodic and idiosyncratic. But overall, you know, the group got oversold. These are the regional banks, right? So we're taking out the big names. The group got oversold. It did have a breakout, which, you know, could have been a bull trap and still might prove to be a bull trap. But we've come into this oversold condition. And I think the important part of this is really the difference in what's happening to the cap structure, right? If we look at the banks, people are worried about the equities. Obviously, that would be the first area to go to. But when we go and look at the credit default swaps and some of the things that are happening in credit, they just couldn't care less. In fact, the credit spreads relative to the market are their lowest in a year, so well below where we were with Silicon Valley Bank. And on an absolute basis, we actually have to go back to 2022 to get CDS spreads to where they are today. So there's a mismatch here, right? Either the credit markets aren't seeing it and the equities are seeing it, or the equities are seeing it and the credit markets aren't. And I think it really is the equity markets are probably overreacting to something that, again, it probably is episodic and has some idiosyncratic non-systemic issues. But I think for the overall regional banks, I think they're actually in pretty good spot here. So I'm not in the bull trap camp.
Meanwhile, Jeff, I know Renmac just posted a reaction to the inflation expectations that we got at the top of the hour, and your argument is that it's not just the printed inflation data, but the expectations data that's sort of leaning in the camp that you think the Fed would want to see.
Yeah, I mean, that's Neil's work, so he can speak more directly to that. But I think the market's been telling you that. I mean, most of the data that we go through and look at, you know, our market cycle clock and some of these other things that we look at have been really giving us a positive bullish message for about 16 months now. I know that's a long time, but we're talking about the end of 2022. And it just continues to do well. The Bloomberg Commodity Index is making a new low. We posted on Twitter earlier this morning how copper hasn't broken yet, but certainly looks vulnerable. That's very consistent with kind of the playbook that we're looking at right now, which is 1995, the soft landing. And, you know, the Fed engineered that. And then it was really 2-3 years of uninterrupted gains for the equity markets. I don't know that that's going to happen. But in terms of the way the market's acting, in terms of the way the styles and the sectors are acting, it's very consistent. And I just don't think that inflation is the big problem that it was, you know, a year and a half ago. I just don't think that we're in that camp.
You hit the buy button on the Russell or the S&P?
Yeah, that's a good question. I mean, you know, it's a fatal flaw, but I'm a momentum guy, so I still like the S&P. I don't think the Russell's bad. It's just relatively underperforming. So you just have this superstar. You know, I think you go with the superstar for now, but I don't look at the Russell as being vulnerable. It's still in a base. It's trying to break out through 2000. I think it's okay. There's a mix shift taking place here that the weightings and the constituents of the Russell are substantially different than what you have for the S&P. You know, forget just the mega cap, just, you know, the technology versus healthcare weightings, et cetera. So I think there's some just product mix that's creating that tension. But I would stay with the winner.